Today we'll finish up futures and we'll do a couple classes on options. We'll get in a little bit more detail on options than we have on futures and actually look at the most common strategies with options. So last class we were talking about futures. I gave you finviz.com so you could see several different types of assets that have futures on them. So let's just do a quick example. Futures, I think, are fairly easy to understand. In my mind, a future is simply another way of buying an asset. So there's what we call the spot market, which you just go out and you buy the asset directly, and then there's a futures market. So let's use oil. Oil's a popular one. You can see I did this some time ago when oil prices were more around $100, but that's fine. You can do it at $50 or $100 or $60. But let's say the spot price of oil is $100. That means if you go out to buy a barrel of oil today, you will have to spend $100. And let's say the futures price is $102. So spot price is what you can buy the oil for today. So you call up someone and says, hey, I want 10 barrels of oil. They say that'll be $1,000. You pay them $1,000 and they send you on a big truck 10 barrels of oil. So you've got 10 barrels of oil. You got to put that in your backyard somewhere, maybe in your garage. Maybe you can put 4 of them in your garage and 2 in the attic and maybe 1 in the spare bedroom, whatever. So you got 10 barrels of oil. So on the futures, what you're doing is just saying, hey, in 3 months I will pay you $102 and you give me 10 barrels. I'll pay you 102 times 10 and you give me 10 barrels of oil. Now, why in the world did you do that? You can get the oil today for $100 and you could just store it. Why would you agree to pay $102? Well, let's think about that $100. If you buy the oil today, you've got to do 2 things. First, you have to store it somewhere, and that's going to cost you something. You're probably not going to keep oil in your backyard and in your attic. You're going to have some place to store that oil, and that's going to cost you some money. And let's say it costs you $1.50 per barrel to store the oil. And you also have the time value of the money. If you buy the oil today at $100, you're out $1,000. You know, $100 times 10 barrels, that's $1,000. You're out $1,000. You could invest that money somewhere else. If you do the futures, you don't have to store the oil anywhere, and you have the money. You don't have to pay anything. When you buy a futures contract, you know, so you promise to buy 10 barrels of oil in 3 months for $102. It doesn't cost you anything today. Now, you may have to put aside collateral. A lot of people make a big deal with collateral. For large institutional investors, when I do these type of transactions, collateral was not an issue. I usually had several $1 billion in assets sitting there that were usually just sitting there for years. I could easily go to the bond manager. I used to go to Donna and say, Donna, I need $500 million of collateral. He says, yeah, sure, I've got a few $1 billion in bonds that are just sitting there. Take what you need. So it was fairly straightforward. So our collateral is just bonds we had sitting in our portfolio anyway. But if you're doing this on an individual basis, then yeah, you're going to have to make sure you have collateral sitting there. You have a margin that you have to set up. And if you go and do this on as a paper portfolio online, you'll get the practice of what you've got to set up as margin. That's really important that you understand that. To me, it's not as big of a deal because I was on the institutional side, but small investors, that can be a huge issue. So there's your choices. You can buy the oil today. It's going to cost you $1,000, and you're going to have to store it somewhere, and it's going to cost you $1.50 to store it somewhere. Or you can do the futures contract. The problem there is the oil is going to cost you $102, but you don't have to do anything with the oil for 3 months. You're not adding any money today for 3 months. So if it costs you $1.50 to store the oil, and let's say the time value of money of that $1,000 or $100, you know, $100 times 10 barrels, let's say that's 50 cents. Well, you're somewhat indifferent. If you buy the oil today, it's going to cost you $1.50 to store it, and it's going to cost you 50 cents in time value money. It's going to cost you $2. So you're really indifferent between buying the oil today for $100 or buying the futures contract for $102. Or you could sell the futures contract. Let's say you do this transaction and say, hey, wow, I'm going to make a lot of money here. I'm going to buy the oil today for $100, 10 barrels. It cost me $1,000, and I'm going to enter this futures contract where I have the right to sell the oil for $102 in 3 months. I've set up a $2 profit. That's guaranteed. And then you start thinking about it, say, yeah, but if I buy the oil today, it's going to cost me $1.50 to store it, and I'm losing 50 cents in time value money. So I'm going to buy it for $100. It's going to cost me $2 for 3 months, and then I can sell it for $102 in 3 months. I've broken even. I've gained nothing except for a whole lot of time and trouble. Why would I do that? And that's called cost of carry. That $2 is cost of carry. It's the cost of storage for things like oil that you do have to store. Obviously, if you're doing a future on the S&P 500, there is no storage cost. It's all electronic. But there's definitely a time value of money. So spot prices and futures prices should just reflect the cost of carry. Now, they don't always do that. And that's when we get in this idea of contango and backwardation. So the futures price should equal the spot price plus cost of carry. And that shows a normal relationship that's called contango, where the spot price is lower than the futures price. You can see in our case the spot price was $100. We get $1.50 for storage, 50 cents for time value money, so the futures price should be $1.02. Now what if the futures price was $104? It's in contango, but it's too high. Then you can buy the oil today, sell the futures contract, and so you would buy the oil for $100. It would cost you $2 to store in time value money, but you get to sell the oil for $104. You've got a sheer profit of $2. Now $2 on $100, that's 2%, and it's 3 months. You multiply by 4 to annualize it. That's 8%. That's a decent return. What if the futures price was 98? What if the futures price was lower than the spot price? That's called backwardation. You might say, well, that's impossible. That would never exist. But it does. In fact, it's not that uncommon. I'm not an oil person. I've seen some spreadsheets that talk about how often oil prices are in backwardation. It's not as uncommon as you would think. And there's a relationship when oil prices are in backwardation versus contango and what usually happens with oil prices going forward. There is some seasonality to oil prices, and so some of that is actually baked into the analysis. But that's not my field. I'm not an oil guy, but if you work for Valero or Exxon, and especially you're in the trade desk, which I'd really highly recommend, if you work for those companies, you try your hardest to get over to the trading desk and really understand how these markets work. It's a really complex area of finance. So here you got this thing where you buy the oil today for 100, but you only sell it for 98. That sounds like a really horrible deal. Now, how would you take advantage of this? How could you lock in a profit? Well, we talked up with the contango. You could. You buy the oil for 100, you store it for $1.50. You got 50 cents time value money. You got a $2 profit. You know for sure. You have everything lined up. You know exactly what you're doing. Yeah, you can take advantage of that. It's hard to take advantage of backwardation because if you think about it, you would have to short the oil today. You'd have to short the oil. How do you short oil? I don't know how any of y'all know how to do that. You know how to short stocks. We talked about that earlier. You just go to your broker and say, hey, I want to sell Apple stock. I think it's too expensive. I don't own any Apple stock. I want to sell my neighbor's Apple stock, and I'll just borrow his stock and sell it. Then when he wants it back, I'll give it back to him. But it's hard to do that with real assets. It's hard to sell your neighbor's house. It's hard to sell someone else's oils. So it's very difficult to actually set up a transaction here where you can take advantage of this. Now, if you had 1,000 barrels of oil in storage and you have a customer that needs the oil in in 3 months, then yeah, you could sell all of your oil that you have and buy the futures. And so you sell all the oil you have for 100, and you have the right to buy that oil back for 98 in 3 months. Then yeah, that'd be great, because you get the money today selling all the oil for $1,000. You can invest it. You don't have to pay for the $1.50 storage, and you know in 3 months you can buy the oil back for 98. Essentially, you're having someone else take over your storage and time value money and do it for free. In fact, for an extra $2. But if you don't already own oil, you don't have that transaction that you can do, then there's really no way you can take advantage of this. There's just no way to short oil in the spot market like you can stocks. So the futures market can be a really good way, very liquid way to replicate, and I love that word replicate. You should look that up. Investment replication. It's when you use another asset or other assets to try to replicate a third asset. We'll talk about that when we talk about put-call parity with the options. Really famous part of finance. So you can replicate the cash market, which is the spot market, the cash market, the spot market. So you enter into an oil future contract to buy oil for 102 in 3 months. You have no cash today. Yeah, you do have to put aside some margin, but that's, as we said, that may not be that big a deal. You select a notional amount. Be really careful if you do this as a paper portfolio, what notional amount you pick, because these things can add up. So you got a notional amount. Let's say you want to do 1,000 barrels. So you got 1,000 barrels times 102. Your notional amount is $102,000. It's not going to cost you anything. You don't have to pay anything today. You set aside the margin, but that's not a price. That's essentially collateral you're setting aside. That margin is still your assets. You haven't sent money to anyone. You've just set aside money. So the notional amount's 102, but you don't actually, on your balance sheet, it's going to show a market value of 0. But the market value of that future is going to change as oil prices change. So let's say oil prices go to 110 in 3 months. So you've got this contract. You can buy oil for 102. So you buy oil for 102, and you immediately sell the oil for 110. So you got an $8,000 gain. Let's say you had done that in the cash market. So you went out and you bought 1,000 barrels of oil at $100. So it cost you $100,000, but you had that $2,000 in carry. So it ended up costing you 102, but you can sell the oil for 110 because the market has moved up to 110. You make the same $8,000 gain. So now which would you rather do? Well, if you're a normal person, you would use the futures market, because a normal person doesn't have a place to store 1,000 barrels of oil. Now in reality, on this futures market, it makes it look like in 3 months we're actually going to buy oil for 102, get those 1,000 barrels of oil, and turn around and sell those 1,000 barrels of oil for 110. That's not the way you're going to do it. What you'll actually do is the day before that futures contract matures, you'll just exit out of it, and you'll get that same $8,000 gain. The last thing you want is 1,000 barrels of oil showing up on your curve. And so you can get the same gain. This is the same thing with options. Most of these contracts don't actually execute at the end. Most people shut them down right before the execution time. And you got to be careful you do that with the futures. If you forget to do that, yeah, you may have 1,000 barrels of oil showing up on your doorstep, or they're going to be calling you and ask, where do you want your oil? That was a big deal last year when the futures market, the oil price actually went negative on the short-term futures because there was no place to store the oil. Everything was full because people stopped driving, and the big oil producers kept producing. There was just no place to put oil, so it created a huge disconnect in the market. But with futures market, you don't want delivery of the oil. So what you want to do is exit that contract right before expiration. You'll gain your exact same $8,000 as if you had gone through this whole transaction, but you don't have to worry about messing with oil. And there's a good chance your broker is going to call you and say, hey, you got a futures contract about to mature. Are you going to get out of this thing? They don't want the oil to show up either. So futures market is really just another way to enter cash markets, especially for those people who don't really have the mechanism to do the cash market. Now, futures and forwards are essentially the same thing, except for futures are very liquid, standardized contracts. Maturity dates, what prices are quoted, what kind of transactions you can do, what kind of, is it 1,000, is it 100? They're usually very large, well-established exchanges, so there's not a lot of counterparty risk. We're not worried about these futures exchanges going insolvent, so you don't have to worry about counterparty risk. Forwards, that includes swaps. Swaps are a type of forwards. These are over-the-counter transactions. They're illiquid transactions, usually between very sophisticated buyers and sellers, usually for extremely large notional amounts, probably in the billions. The swaps I did were in the billions. It's just, they sound like really large amounts. Remember, the market value is zero, but the notional amounts can be huge. You can negotiate terms. The first swap I did, my broker called me and he had this 30-year zero coupon swap, and it was a 5-year contract, but this 30-year zero coupon. And I thought, wow, that's perfect. That's exactly what I want, because then I don't have to worry about netting out the interest payments. Just a lot less work for my custodial bank. I thought, wow, that's perfect. That's what I want. It gives me as much duration as possible, and it's fewer transactions, less for the accountants have to do. I thought, perfect. So I got exactly what I wanted. And that entire conversation was maybe 10-15 minutes. It was a very, very short conversation. So forwards and swaps are less liquid than futures, but more flexible, but they do expose you to counterparty risk. When you're doing forwards and swaps, you're not dealing with an organized exchange. You're dealing with an investment bank like Morgan Stanley or JP Morgan. And so you do have to worry about counterparty risk, and especially in 2008, one of our swaps was with Morgan Stanley, and when Lehman went under, we were very, very worried about Morgan Stanley. I actually recommended the department that was responsible for that. Now I'd moved on to another job. I'd recommended that they get out of that swap, and I wish they had done that, because they would have made about $15 million if they had done it, and reduced their risk. They would have had a double benefit of reducing their risk, and they would have made $50 million. That was during that time of Lehman Brothers going under. If Bank of America had not bought Merrill Lynch that weekend, I really do think Morgan Stanley and Goldman would have gone into receivership. It would have been a horrible, horrible next week. It's just amazing. We think about how bad 2008 was. What most people don't realize is how much worse it could have been. It's really quite frightening. All right, as I said, most future contracts are settled in cash, not with actual physical delivery. You just unwind the contract, and this is going to be the same thing we'll see with options. So let's talk about options. As we said before, an option is the right, but not the obligation, to buy something, that's called a call, or the right to sell something, that's called a put, sometime in the future at expiration date. The expiration date, the stated price, the strike price, what you can buy it for or what you can sell it for, those are usually part of the contract. These are standardized contracts for the most part. There are some exceptions, swaptions, your auto insurance. There are certainly some over-the-counter options that we buy and sell that are not standardized, but the options we're going to talk about are very standardized contracts. Now, does that have any value at all? So if right now, let's use Apple as an example. Let's say Apple right now is trading for $135, and let's say you want to buy a call option on Apple at $140, and maybe it's 3 months. So anytime in the next 3 months, you can buy Apple for $140. But Apple right now is trading for $135. Why in the world would you buy Apple for $140 when you can buy it for $135 today? So does that have any value whatsoever? And a lot of times I ask that question in class. Unfortunately, we were online, but I'll ask that in class, and I have a lot of students that says, no, that has no value to me at all. But what we've learned in finance is options almost always have value. Now, you have to say what is it. I mean, it's possible the value is pretty close to zero. But if someone says you have the right to do this, but you don't have to do it, that usually has some value. If you think about options you put on a house, the option to buy it, that has some value to you, because you can go out and look for other houses. You might find a much better deal, or the real estate market might crash, and you have the option to buy this house for $500,000, but while you're thinking about it, the whole real estate market crashes, and you think, or maybe mortgage rates shoot up, and you just think, wow, you know what, this is not a good deal, I'm going to walk away. That has some value for you. What is that value? Is it $500? Is it $5,000? That's the hard part. You got to figure out what that is worth. But let's look at this 135 Apple stock that we have the right to buy for $140 in the next 3 months. Let's see what the market thinks that's worth. So I come into Yahoo Finance, and I'm going to type Apple over here and look up Apple. When Apple comes up, one of the choices that we will have is options. You can see it right over here, options. So let's click on options. You can see Apple's not quite 135, about 134, but that's fine. So we go over to the option side. And I said 3 months. So 3 months were April, so May, June, July. Let's see if we can find a July date here. There it is, July 16th. Almost perfect, because I'm doing this on April 17th. So that's almost perfectly 3 months out there. You can see it starts with the calls, and then it goes to the puts. We're looking for a call, and what did I say? 140. There it is right there. And Apple 140. So what are all these amounts right here? So let's look at the title. The last price is actually not all that important, and that's because, and I learned this real quickly when I was doing options. The last price is usually what brokers and custodial banks and accountants, that's what they want to record on your books for your financials. That works fine with stocks and bonds. Or bonds, it can be a little tricky, but with stocks that usually works well. With options, that doesn't always work well, because that last price could be a few days old. You look at the interest and the volume on some of these. The volume is 1, so that last price could have been at 9 a.m. and the market could have moved a bunch throughout the day, so that could be a really, really old price. Some of them have a whole lot more trades, like 1,200. Yeah, that's probably a more reliable price, but still, it's a little tricky. So the next one is the bid and ask, and we're going to be using the bid and ask on the exam. You can even tell with this first one, the last price is not. The last price should be close to the bid and ask. You notice on some of these, the last price is really far away because the trade happened so long ago. So the bid is what someone's willing to pay you for that option if you were to sell it. The ask is what you have to pay. Now, how do you know? Well, it's pretty obvious. The higher number is what you have to pay. The lower number is what you receive. So you can receive the bid, or you pay the ask. And so what we did at UTSA, the accountants initially when I was doing options, they were recording last price on our mutual funds. And I remember one day I noticed my net asset value on my mutual fund just did not look correct at all. I said, there's no way that's correct. So I went to the accountants before they went home and said, there's no way that's correct. And they looked at it, and the last price was very stale. It was a few hours old. And so what they did after that is they started using the bid and ask. They used the midpoint between the bid and ask, because the bid and ask is updated much more frequently, throughout the day. That's the market makers continuously providing their latest willingness to pay. And so the midpoint between the bid and ask is actually a good number to use. I do this. I do the accounting for my charity, and we have a lot of options. And so you can see how material it could be if you use the midpoint between the bid and the ask. You might use about $80, but the last price was $89. That's a 10% difference, more than 10% difference. You would be really, really misstating your financials to do something like that. But let's go to 140. So we go to 140. you can see the bid and ask are $5.25 and $5.30. So people are willing to spend about $5.30 for the option to buy Apple for $140 when it's currently trading for about $135. You notice this blue line here? Apple's currently at $134. The blue line shows you options that are what we call in the money versus options that are out of the money. What does in the money mean? Well, the right to buy Apple for $130 is a great deal when the stock is currently $134. So we call that in the money. That's a great option. The right to buy Apple for $140 when it's currently trading for $134, that's not a good deal. It's out of the money. We're going to look later and see that that means it has no time value. But we'll get into that. We'll talk about time value. So yeah, the market says there is a value. Why is that? Well, you pay $5.30 and in the next 3 months Apple's stock price goes to $150. Well, boy, that's a huge advantage. If you think about it, you could buy for $134. It goes from $134 to $150. You made $16 on a $134 investment. But if you buy this option, you pay $530. The stock price goes to $150. You make $10, and you only invested $530. So you can make $4.70 net, right? So you're going to make $10 because the stock's now $150. You get to buy it for $140, so you got this $10 gain. You only had to pay $5.30 to get it. So essentially, you're going to get a $4.70 gain on something you paid $5.30 for. Your return is going to be much, much, much higher. And that's what options do, is the fact that that stock price can shoot up. You only have to pay $5.30. You can take that $5.30 and have a $4.70 gain. That's a huge, almost 100% gain that you're going to get on that option versus if you buy the stock and you're up $16, you paid $134, it goes to $150, you make $16. That's not that big. It's a good gain, but an 8% gain, but it's not a 90% gain that you can get on the option. So that's why the option has some value. If you think Apple stock's going to go up, you'll make a much higher percentage return buying the options than you will if you buy this stock. So let's get into this a little bit more. Obviously, there's a lot more we can talk about here, but the best way to understand this is actually do some transactions. So yes, options always have value. Sometimes the value, the right to buy Apple for $800 over the next 3 months, maybe that value is a fraction of a penny. But if someone says, hey, I'll give you the right to buy Apple stock for $500, as many shares as you want, I'll give you 1 million shares, I'll charge you 1 penny for the right to buy 1 million shares of Apple for $500. Yeah, I'd probably do that. Here's a penny. Who cares? Something might happen. Apple might come out with some new invention and their stock price just takes off. Who knows? Maybe Alphabet puts a bid in for Apple or something. It's unlikely that their stock price is going to triple, but you saw what happened with GameStop. Can you imagine that transaction with GameStop when it was trading for $15, $16, and you say, hey, I want the right to buy GameStop in the next 3 months at $300. If you'd paid a penny for that for 1 million shares when GameStop went above $400, but you would have made a huge return. So it is possible. It may be incredibly unlikely, but it's possible. So now there's a high probability of loss. There's a good chance you'll lose in 100%. So this is an extremely skewed transaction. You can lose 100%, probably 80-90% of the time, but you have a chance for 100, 200, 300% return 5 or 6% of the time. Or even, I've had options that were up 40,000% over the weekend. Yeah, you can have huge gains very, very quickly. So your max loss is 100%, but your upside can be massive. So yeah, very skewed distributions. Now before we get into the actual transactions, we got to understand how option prices work. We're not going to get into option pricing models. I do encourage you to take that class. UTSA does have that class. We have a new professor teaching that. Sounds like a really good professor. He had one of our former Investment Society members talked to his class, and Eric Moss is now up in Chicago trading options. This is his career. You can get in this a lot more detail. When I traded options at UTSA, my option broker, extremely knowledgeable, he would send me spreadsheets with all this information in it. It was just real. I could just see that my knowledge of options was not what was needed to really do well in this market. It's a tough market. Most retail investors trading this market are losing. They're getting ripped off because this market is for sophisticated buyers. But you can, by pure luck, do extremely well in this market. But for the most part, on average, it's not a great market for retail investors, although retail investors do these transactions a lot. But the question is, what drives that option price? We saw for Apple it was $5.30. How do we come up with that $5.30? And so this is the mnemonic I've come up with. We call it Texas Video, TXSVID. I used to ask this on the exam, but given that it's open book, it's kind of stupid to ask this question. But I would still memorize this. You should know this permanently. This is extremely important stuff. So I won't do it in the order of TXSVID. I'm going to switch it around a little bit. But the T is for time, the X is for the strike price, S is for the stock price, V is for volatility, I is for interest rates, and D is for dividends. So I switch the X around because I like to start with the strike price. So the first thing that influences the price of the option is the strike price. With Apple, it was $140. That was our strike price. Our right to buy Apple for $140, that's going to influence it. So with a call option, the higher the strike price, the less valuable the call option. We already saw that when Apple stock was at 140, when the strike was 140, the option premium was 530. However, when the option price went to 145, you can see that the option price dropped. When it goes to 150, it drops even more. For put options, we'll come down here to put options. If I had the right to sell Apple, say for 120 or 125, I had the right to sell Apple for 125. Well, that's out of the money. You notice with puts, the blue is below and the white is above. This is about when you have a right to sell Apple for 125 and it's currently trading for 134. That's not a good deal. Who would want to do that? So with put options, the lower the put strike, the less valuable the option. The higher the strike, the more valuable. The right to sell Apple for 145 when it's currently 134, that's a great value. So for the strike price, the higher the strike price, the less valuable call options are, the more valuable put options are. Now the second thing is time. I showed you a 3-month option. If I had shown you a 6-month option, all of the option prices would have been higher. So options generally mature on the 3rd Saturday of each month, although there's a bunch of new options that have been offered now. But generally, if you go out far into the future, like we saw in July, the only option we had was a July 16th date. That's that 3rd Saturday of each month. So, it's really the 3rd Friday because Saturday is not a business day. So time's easy. The more time, the more valuable the option. Doesn't matter if it's a call or a put. A 6-month option would be more valuable than a 3-month option. The only time I've not seen that to be true was during the 2008 crisis. And I was so tempted. It was hard for me to do trades because of my job. I was really locked out of the market. But there was one point where the 1-month option was more valuable than the 3-month option. Now, I may not have been, if I'd actually tried to do transaction, I might have gotten killed with the bid ask, and it may not have worked at all. But it was tempting to try to set up a trade that would have worked. So we're going to talk about time value. But there's something called time decay. So you saw with Apple, we had a strike price of 140 to buy the stock at 140 when the current price was 134. So that's what we call $6 out of the money. If an option is out of the money, 100% of that option premium is what we call time value. It's entirely time value. So if you're in the money, we have what we call intrinsic value. So intrinsic value is, let's say we have the right to buy Apple for $130 and it's currently trading for $134. It has intrinsic value. It's what we call $4 in the money. Well, if it's in the money, it has intrinsic value of $4 because we can pay $4 less than the current price. So that's intrinsic value. So time value is the option value minus the intrinsic value. So when the option price was 140, there was no intrinsic value. It was out of the money, no intrinsic value. So if you're out of the money, 100% of the option value is time value. So that $5.30 on the 140 strike for Apple, that was 100% time value, zero intrinsic value. The time value of an option is going to decline to zero over time. That's what we call time decay. So as you get closer to maturity, the time value decays down to zero, and that's why options are more valuable the more time you have, because that's that time value. It's essentially the market saying, hey, there's a chance this stock price could shoot up. You're going to have to pay for that possibility, and the time value of an option really does express the probability this stock price is going to shoot above that strike price. So we'll talk more about that. We're actually going to calculate that. Intrinsic value cannot be negative. It can be zero, but it can't be negative. So if you're out of the money, then you have zero intrinsic value, so the entire option premium is time value. The next thing is, let me say one thing on the strike price I forgot to say. I use X for strike price. If you ever go bowling, a strike is shown as an X. You will see K as the strike price. So if you do baseball, a strike in baseball is a K, it's not an X. So that's the one. So you can say Texas video or maybe tickets video, either one, TKS or TXS, either one works. So I've seen it both ways, X and K, depending on if you're a bowler or a baseball player. I didn't use X here because I'm more of a bowler than I don't do either one anymore. But that's just the way I was trained to use X, so just be aware. The S is the stock price. We talked about Apple was trading for $134. That's what the S is. The nice thing about the S is its impact on option price is the exact opposite of the X. The higher the underlying stock price, the more valuable the call option, the less valuable the put option. So if Apple price would go from 134 to 154, that call option would shoot up from $5.30 to a much higher number. Put option prices would fall. Volatility, this one's just like time. The more volatile the stock price is, the more valuable the option. And the interesting thing about volatility is the one thing we do not know when we enter into the contract. It's the one unknown. We know the time, we know what the expiration is, we know what the strike price is, we know what the current stock is trading for, we know what interest rates are. We have a pretty good idea what dividends they're going to pay. That can be a little uncertain, but the one thing we do not know, because volatility is not the volatility of the stock the last 3 months, it's our expectation of what the volatility of the stock will be the next 3 months. And that's usually highly correlated. If you look at how volatile the stock has been the last 3 months, that should predict going forward. But something like GameStop, when that stock just suddenly everything changed, the historical volatility would not tell you the volatility being priced into the option market. So it's an unknown. It's the one thing you're somewhat betting on, and we'll talk a little bit about that when we do some of these strategies. And it's really what makes options so much different than any other type of security, because for both puts and calls, higher volatility makes the option more valuable. Very different than anything else. We talked about valuing stocks in papers 3 and 4. The more risky the stock, the less valuable it was, because you increase your discount rate. So with most assets, more risk means lower valuation. That's not true with options. Options are a very different animal. The more risk means more valuable, and that's why you have to be really careful when you're looking at a security. If you're looking at it in the capital asset pricing model context, option land context, and it can make a big difference. There are some stocks that are so volatile, and they're essentially worthless stocks, but they have the chance that something might work out. If you value that stock using CAPM, you're going to get a very bad answer. You're going to say, wow, that stock's not worth anything. You do the valuation. But those stocks are really not stocks. Those are really options. They're companies that are, there's a 95% chance they're going to go under, they're going to go bankrupt, but there's a small chance something might happen. We saw that with Kodak when President Trump mentioned Kodak might be helping with the vaccine. Suddenly Kodak stocks shot up. Kodak's an insolvent company. No one's buying cameras anymore, definitely not buying film anymore. Just a business that did not work out, just in the wrong place at the wrong time. It was a great business for many, many, many decades, but then just the world changed with digital and iPhones and smartphones. But it suddenly moved. Why? Because there's that optionality. Maybe there's something there. Maybe something can work out. You do not use the capital asset pricing model to value firms like that. The next one's interest rates. Interest rates is a little tricky. You have to kind of stop and think about this. It's a very similar concept to what we have with futures. That if you use the futures, you don't have any cash out today, so you get to delay that cash out. So if you do a call option instead of buying the stock, you since benefit from the time value money. If you do a put option instead of shorting the stock, you lose on time value. And so higher interest rates increases the value of a call, because instead of buying the stock today, you do the call and you get to delay that. So instead of paying $134 for Apple, you just pay $5.30 for the option. And so you have that extra $130, $128 that you don't have to spend. So higher interest rates make that call option more valuable. A put option, you could sell the stock today, or you could just buy the put option. So there you're out the time value, so higher interest rates decrease the value of the put option. I wouldn't worry so much about that one. Interest rates are so low right now. We're not talking, I know the 10-year is getting up above 5, 1.5, 1.6. But we're not talking about the 10-year treasury. We're talking about 3-month interest rates, and they're still extremely low because the Fed just is not raising rates. And then dividends impact stock prices. I'm going to ignore that. And the reason for that, and we talked about that when we talked about the holding period return, when a company goes ex-dividend, the stock price falls. So obviously when you go ex-dividend, that's going to hurt the call option. It's going to help the put option. So that has to be incorporated into the price. We usually know what the dividend is going to be for a stock, or at least can predict it pretty well. Most companies are pretty predictable, at least within a few pennies. So that tends to be a very easy to forecast. But there are times, I showed you Choice Hotels when they pay that special $10 dividend. When a firm does that, boy, that can absolutely disrupt option markets and create that's when the SEC is going to step in and say, who knew about this special dividend, and were they buying a bunch of put options going into it, because that would put them in jail if they had done that. Now, closely related to the Texas videos are the Greeks. This is something where you could definitely get a lot more in detail. So the Greeks is simply ways we measure our exposure to options. Delta is the most popular. What it says is, what's the percentage change in the option, or the option strategy? We may own several different types, given percentage change in underlying. So the delta could be 60 if Apple stock goes up 10% and our option goes up 6%. So that tells us our delta, how much exposure we have. Deltas can be 0 if you're really, really way out of the money. It's just like doesn't have any impact at all. Gamma is essentially the change in the delta giving the change in the underlying. Gamma can be extremely important. We're going to talk about one of the strategies, which is a covered call. A covered call, gamma is extremely important. I used to hate the gamma on our strategies when we did covered calls, and I somewhat moved away from covered calls. Theta starts with a T, so that somewhat helps. Theta is the percentage change in the option price just because you move one more day into time. That's the measure of that time decay. Vega starts with a V, so that's kind of nice. Vega shows the percentage change in the price of the option give a change in that implied volatility. Implied volatility is that expected volatility during the remaining life of the option. As that changes, obviously as it goes up, it's going to make the price of the option go up, but how much? How sensitive is it? Well, that's what the Vega is going to tell you. And then rho is not one I hear most people talking about, but rho tells you how sensitive is the option price to changes in interest rates. And I just don't know anyone who's written a lot of papers or done a lot of analysis on that. All right, so we've talked some of this: in the money, out of the money, at the money. If the current price is higher than the strike price for a call, you are in the money. So in our case, if Apple's trading for 134 and our strike price is 130, that's in the money, so it has intrinsic value. If the current price is higher than the strike for a put, it's out of the money. So if we have the right to sell Apple for 130 and it's currently trading for 134, we don't like that. That's out of the money. It has no intrinsic value. If the strike price is greater than the current price for a call, so we have the strike price of 140 and the current price is 134, that's out of the money. It has no intrinsic value. It's 100% time value. For a put, the strike price is higher. That's in the money. It has intrinsic value. And in the rare cases where the strike price exactly equals the current price, that's pretty tough because right, Apple's trading for what, 134.16 something. You're not going to have that as a strike price. In fact, we had 130 and 135. We didn't even have 134 as an option. So it's hard to get something that's exactly precisely at the money. I've seen it every once in a while, and those are actually pretty exciting to me because I can actually demonstrate put-call parity with those type of options. But it's tough to find those. You can be close to right at the money. That 135 strike price for Apple when the current price is 134. We might say that's close to being at the money. It's going to be about as close as we can get. Alright, so we've got a few equations here and we're going to start executing these. We'll see how many we can do today, and the next class we'll finish it out. But you can buy a call option. That's called going long a call option. You can go short a call option. That's called writing, W-R-I-T-E. You can write a call option. That's when you sell a call option. That's a very dangerous strategy, very, very dangerous strategy. You can go long a put option. That means you buy the put option. You can go short the put option. You can write the put option, write a put contract. That's when you sell it. So that can be very, very dangerous as well. In fact, in 1987, there were a lot of elderly people selling out of the money put options on the stock market, and when the market fell 23%, they lost everything. It was a disaster. So here's the formula you have to know. The max for a call option is the max of the stock minus the strike and 0. So if the intrinsic value is 0, the most you can lose is 0 minus the call option. So max S minus X comma 0 minus the option price. For a put option, it looks exactly the same except where we switch the strike and the stock. It's the max of the strike minus the stock price and 0. So for the call option, we would say the max of our strike was 140 for Apple, and the actual price was 134, so we do the max of 134 minus 140. Well, 134 minus 40, the max of that in 0 is 0, minus the call option. The call option was 530. So if that call option on Apple, that 140 strike, if Apple in 3 months was still at $134, we would take 134 minus 140, that's minus 6. That's less than 0, so 0 minus, and we paid 530, minus 530, we would have lost $5.30. We would have lost 100% of our money. For the put option, it's the strike minus S. So just know this formula. Now, I said this is long a call option. What if you're short a call option? How do you figure that out? Well, it's actually pretty easy. Put a parentheses around this entire formula and just put a negative sign in front of it. So the math is exactly the same. It's just then you change the sign. The only difference is going to be the option premium. When you buy a call, you're going you're going to have the ask price, the higher price. When you sell a call, you get the bid at price. So if you're buying something, put the higher number there between the bid and ask. If you're selling it, put the lower number there between the bid or ask. So you have to switch between a bid and an ask. But other than that, this formula is exactly the same, whether you're going long or going short. It's just that if you're going short, you put a minus sign in front of this whole thing. So if you're selling a call option, you receive the call premium, but you still put the whole thing into the formula. And so let's say you were selling that Apple option. Remember, it was $5.25 bid price. So at the end, if Apple was still at 134 minus 140 and 0, that's 0, minus $5.25, that's minus $5.25. Put a minus sign in front of that, and that means you would have made $5.25 on that option. Alright, so we're going to go through these examples, and then there's other combinations. You can combine calls, you can combine puts, we'll do that. Sometimes we buy calls and puts. Sometimes you'll buy a put and sell a call. There's all different ways to do it. You can mix long and short positions. You can mix strikes. You can have 140 and something called what we call a spread. You can do a spread where you buy a option with a strike of 140 and you sell another option with a strike of 150. You can mix maturity dates. We're not going to look at that, but you can mix maturity dates. I'll talk about it when we talk about callers, how you can mix maturity dates. I can't actually demonstrate it to you in numbers because we're keeping this fairly simple. But you could buy a call, or you could sell a call that matures in a month and buy a put that matures in 2 months and mix it all up. You can hold the underlying security, so we could buy Apple stock and buy a put option on Apple stock. We'll talk about that being a protected put. And these combinations bring up something called put-call parity. And I highly recommend you look that up in Wikipedia or in Investopedia. It's a great concept. I really love it. I would know this by heart. What it says is, and this comes back to replication, this is the way it looks like as a formula. C plus DK equals P plus S. Well, C is a call, the call premium, that $5.30. P is the put premium, so whatever the put premium was. So if we're doing this right at 135, whatever the option is, right at the money, maybe the call premium is $2 and the put premium is maybe $3, we put that into the formula. The DK, I put it as present value K. Essentially that is the strike price in today's dollars. So if your strike price is 140 or 135, in 3 months you take 135 in 3 months and you discount it today at the risk-free rate. And that's what the DK is. And then the S is just like we've seen before, it's the stock price. So if we were doing a call and a put at $135, I can't actually show this to you because this formula requires you to be right at the money, so it gets a little tricky to do that. But it might work. It gets a little tricky with bid and ask. I'll try between now and next video if I can find a really good example to make all this work out. It's a little tricky. But so if the call price was $2, the present value of $135, let's say that's $134. The put price is $3 and the stock's currently trading for $134. If you did all of that together, these two must equal each other. They have to equal each other. Why? Because we know at expiration this whole formula will equal each other. The strike price will be the strike price. So you don't even have to do the present value at expiration. It will be that. We know what the call is going to be. We know at expiration this whole thing must equal itself. If it has to equal itself at expiration, then it must equal itself throughout the entire life of the option contracts. So if this is 2 plus 134, that equals 136, and this is 3 plus 134, that equals 137, then you could buy this for 136, buy this for 136, sell that for 137, you make $1, and you know at expiration it will be worth 0. How much of that would you do? I would do $1 trillion if I could. If you know for sure it's going to be worth 0 at the end, then and so throughout the life of the contract, these must equal each other, and we can switch these things around. That means the stock, let's say you want to buy the stock, but you can't get your hands on it for some reason, or maybe, so let's say this side of the equation is more expensive than that side of the equation. So what could you do? Instead of buying the stock, let's say the stock's 134, but you can do all of this at 133, what do? Well, you sell the put option, you buy the call option, and you invest in a bond that's going to mature at the strike price that these two are set at. If you do that, and let's say this is 133 and this costs 134, then you do this for 133, and what you could do is buy this for 133, short the stock at 134, and at the expiration of the put and call, the two are going to be equal. You've got $1, you get to keep that $1. It is hard for me to demonstrate because I just cannot find an option that's trading at the spot where I can actually demonstrate it. But the times I have found it, it gets really close. You do have issue with the bid ask. If you actually find a mispriced security and you try to enter this, you'll probably lose all of your game because of the bid ask. Remember, you have to pay the higher bid price and you only receive the lower, and you have to pay the higher ask price and you receive the lower bid price. You're probably going to get killed on that, and you'll lose everything unless you're a big hedge fund trader. And hedge funds are looking out for these things all the time to see if there's opportunity to make risk-free profits. Okay, so what strategies are we going to do? We're going to look at several of them. We're going to look at a protected put, a covered call, a straddle or a strangle. We'll actually be doing a strangle. And a collar. We won't do spreads. I don't think we'll have time for spreads, and they're a little more difficult to actually demonstrate. Spreads are pretty popular. I do like spreads, whether you're doing condors or butterflies. There's iron court. There's a bunch of these that are really, really quite popular. Eric Moss was talking about some of his favorite ones. There are some pretty interesting ones because the payoff just looks really, really attractive. They're probably not as attractive as they look on paper. If you look on the class notes, there are websites that you can click on. I showed you through these to you earlier, last class, that you can go in and get much more detail on these strategies. So what I'm going to do, I'm actually going to stop here, and then next video will go longer. We might go 70, 80 minutes next video. So be ready, next video will go longer. We're going to do a long call, a long put, protected put, covered call, long strangle, and a collar. And then on the exam you'll have to do the long call, a long put, and then I will pick one of these other ones, and you'll have to figure out what the other one is, and you'll do that one, and we'll also do the time value. So we'll talk about time value as well.